Hi everyone, David here from Mortgage Choice. Thanks for joining us for our 2024 RBA announcement, first one of the year. And some good news, cash rate has been left on hold at 4.35%. Now, we were expecting this for a little while, especially as inflation had dropped quite drastically over the last few months from November. So good news, but we're still not out of the weeds as we'll discuss soon. Now, I do have a rather short video today, very, very similar to my one in December actually. So let's kick it off. Now we're going to run through the statement itself and just a really brief outline of what we're seeing right now for first home buyers, upgraders, and investors. Now, as I mentioned, the interest rate, the cash rate, was left at 4.35%. What I did want to highlight is their reference again that we're not going to hit inflation or the target inflation rate of 2 to 3% until 2025. And so for that purpose, we're likely going to see interest rates where we are now around the 6% mark, a little bit over 6% for quite a while. Lenders are bringing out lower fixed rates for 1 year. They're also bringing out larger discounts on variable rates. So things are changing, but for the most part, we're going to be sitting around that 6, a little bit over 6 for another 12 months or so. Now, first home buyers, we're still seeing a lot of properties sell for less than the quoted range, or at least less than the top of the quoted range, which is fantastic because for a long period of time, the quoted range seemed just like a bit of a guide and not where things were actually going to land. You'd quite often see that if it was quoted within, say, 540 to 590, it would sell for 600 plus. So that's changing, which is fantastic. And hopefully it will stay that way. In terms of the offers that our clients are having accepted, we're seeing a lot more in terms of conditional acceptance rather than price range acceptance. And so what I mean by that is, a price range of 540 to 590, a client might offer 560, but with less conditions on the contract. So they might not offer subject to finance because they've already got their pre-approval, or they might not offer subject to building and pest, things like that. The less conditions that you put on the contract, the more risk you have. If things go wrong, you've got less clauses that you can use to escape the contract. But that's something else that has been really helping them. Another benefit for a few of our clients is actually the settlement period. Typically, a settlement will be 30, 60, or 90 days. And we found recently that it's actually suiting a lot of vendors for a long settlement period. And so, our clients being able to offer whatever period that may be. They're still living with family, they move in 30, 60, 90 days, not really important. Whatever they can offer that suits the vendor's needs helps get their offer over the line. And so there are a few other things that you can note in your offer, a shorter or longer settlement period based on what the vendor needs, or less conditions if you know that those things are already taken care of from your side. So a lot of first home buyer activity at the moment and a lot of them getting across the line, which is great. In terms of upgraders, bridging finance is still very, very common. We're seeing a lot of bridging finance, and it just makes sense these days. You don't want to sell until you've found a house to move into. Moving twice is a pain, so this is the way to go and avoid that. We're also seeing a lot of downgrading or a lot of inheritance, unfortunately, coming into play, and then being able to purchase the next house with a minimal, if not nil, mortgage. So great for our clients. Reducing their monthly mortgage repayment. In terms of downgrading, you hit the same sort of question mark where will you settle on the sale before your purchase or settle on the purchase before the sale? Same situation, but there are a few different ways that we can go about downgrading if your debt is going down, and a few ways that can actually simplify the process without needing bridging finance per se. So that's one, if you're looking to downgrade, definitely reach out. Because we can simplify the process, avoid thousands of dollars worth of fees, and you end up in the same position. So worth a conversation, that's for sure. For all of you investors, lenders are becoming a lot more lenient when it comes to rental yields and rental expenses. So we now have a few lenders that have adopted the policy of, we'll shade your rental income to 80%. And then I don't need to worry about whatever those expenses are. The reason that's a fantastic policy is because some properties actually do have quite large ongoing expenses for body corporate fees or if they've got a holiday rental, the cost of cleaning and maintenance of that property can be quite high. And if we're ignoring that cost when looking at borrowing capacity, that can increase borrowing capacity. On the flip side, we've also got lenders that are willing to take 80% of the rental income, but they don't mind what that yield is. Typically, lenders will only take a 6% yield on a property, and in some cases, lenders are now happy to take that at 10, 12%, whatever the yield is. They're still just shading it to 80% of whatever that yield will be. So another great policy to increase borrowing capacity and keep investors in the market. Something else that might help, or also a little bit of a misconception, is rental income. When you're buying an investment property, it might sound simple to some, but this is a genuine question. If you're looking to purchase a property, it doesn't have to be tenanted right now. You can purchase a property and propose to rent out that property. On the flip side, if you're living in your home and you want to buy a new home but turn your current home into an investment, you can use proposed rental income. So whatever the situation is with the house that will be an investment, essentially the bank will go out and inspect the property, value it, and the valuer will make a note of what they think it will receive in rent per week. And that figure is what the bank can use. Even if no one's tenanting the property right now, or if you're moving out of the home and the tenant will move in, it's the proposed rental income that the bank will take. So that's a nice way to get around having to speak with agents or really have no idea what the bank will take. You can get a valuation and we know pretty quickly from there. Lastly, just a bit of an update in terms of interest rates. Owner-occupied rates are about 5.94 to 6.2 if you're looking in the really sharp rate. Some are a little bit higher than that, depending on loan-to-value ratio and lender and things like that. But 5.94 to 6.2 is a good rate, really good rate. Investments just a little bit higher, 6.14 to 6.4 in that bracket. So again, depends on your equity position, your loan-to-value ratio, what lender you're with, and a few other bits and pieces, especially borrowing capacity with different lenders. But we've seen, you might have noticed since the last email in December, that owner-occupied rates have gone down a little bit. And that comes back to what I mentioned, where lenders are changing their offers. They're changing the discounts they give to loans and what rates you'll end up with. It's all about asking the question, can I get a better discount, or do I need to look at another lender? So that's what we're here for. If you are in the market to, have a rate review or downgrade, upgrade, please reach out. Always happy to run through the options. And typically what we want to see is that we take the path of least resistance for you. If we can get you a rate of 5.94 with your current lender, there's no need to move lenders unless there's another purpose. So that's what we want to do. Make sure that you're in the best position possible and get to that best position as smoothly as possible. So thanks for watching, and I look forward to speaking with you all soon.